South Africa's Bank of Last Resort has been using the tools at its disposal to help burden consumers before and during the COVID-19 pandemic. So far this year, the Reserve Bank has cut the repo rate by 150 basis points. It has relaxed accounting and capital rules to release additional money for lending. Furthermore, the central bank has also more than doubled its holdings of government debt, helping to reduce borrowing costs in the domestic bond market. But is it ready for the phased reopening of the economy with additional assistance?
Central banks can provide liquidity while challenges like fiscal sustainability are best dealt with elsewhere. We reduced the repurchase rate, the repo rate, by 100 basis points. We then held an emergency meeting in April, and we based a further rate cut on the forecasts that had been incorporated since the lockdown. In May, we cut the repo rate by a further 50 basis points.
Analysts say inflation may be a problem in the short to medium term. This as the country awaits to measure the impact of monetary policy measures in the phased reopening of the economy. There are ongoing concerns over job losses. And with the easing of the lockdown regulations, trade and investment will be hugely impacted.
Over the short term, there are simply no inflationary pressures by and large. Consumer confidence is quite low. Unemployment continues to rise, given the difficulties many companies are facing. But also, if we just look in terms of income, outside of those that have lost jobs, many people have experienced a cut in their wages, which means incomes have reduced significantly. However, if we look over the medium to long term, the situation can be different depending on how the debt is going to be financed. If it is going to be financed by monetary printing, that can be inflationary. But listening to the SARB governor in today's talk, that is unlikely to be.
Analysts are predicting the local economy may contract by 10% this year. They say the central bank has put in place enough measures to ensure economic sustainability. But the bank says COVID-19 has presented challenges in forecasting domestic economic activity.
My informed guess is that the economy is likely to contract by around about 10% this year. And the next couple of years are certainly not going to look very much better. In fact, I think it's probably going to take us the best time of at least 10 years before the South African economy will be where it was a few years ago. The reality, however, is that monetary policy can go so far to support the economy and not much further. And I'm afraid that monetary policy under these sort of circumstances is simply not enough. We need some serious structural adjustments to get this economy to grow again. But from the Reserve Bank side, they've done certainly what they can do, and there is a possibility of even a further reduction in interest rates. But don't expect the Reserve Bank to perform some sort of miracle, and in any event, most of the problems in the South African economy are problems that cannot be solved by the central bank.
Even so, the Reserve Bank's critics accuse it of not doing enough to support the economy and create jobs in a country where nearly a third of the workforce was unemployed even before the coronavirus struck.
Unemployment was already a major problem before the COVID-19 crisis, with their unemployment rate in the region of 30%. And at the same time, it's necessary to remember that the Reserve Bank's mission is price stability, thus keeping inflation under control, and financial stability in the country.
Whilst getting the economy back to pre-pandemic activity levels will take time, the Reserve Bank expects the economy to contract by 7% this year, worse than the 6.1% contraction forecast in April. Governor Lesetja Kganyago says the central bank stands ready to provide additional support as and when it is necessary. Nothando Makutulela, SABC News, Johannesburg.